But equally, I think at these times it's keen to have calm heads and talk about, from an investor perspective, what is happening in the markets. So, Paul, without
increasing your net worth is a bit of a slog. It's not a physical slog, but you just need to keep going at it. You need to keep putting money where that is the surest way of increasing it. Is to keep
what should, and this is not what could, this is kind of what should people be doing right now to maximise their savings. Welcome. How's your first week, your only week, how's your week been at True Potential?
Oh, it's been really good. I've really enjoyed it.
Hello everybody and welcome to the True Potential podcast number 107. The title today is How to Increase Your Net Wealth Within a Year. So not a challenging title by any means. I'm joined today by the usual array of illustrious guests, and I'll introduce them as we go around. On my left is Paul Duddens. He's one of our investment directors, and it's going to be crucial today that Paul talks us through what's happened in the markets this week. Over here on my right is Neil Rayner, who is the director that runs our central advice team. So when your clients and yourselves are calling in, it's no doubt you'll either speak to Neil or one of his team. And on my right, to the nearest part to me, is Phil Elvin, who's our sales director, who runs all our interactions really with our advisor base. So welcome, gentlemen.
Hello.
I'm going to set you some challenges today. We're going to go through the normal sort of routine. First, I'm going to ask Paul to talk through some of the events of the week. They have been momentous, and some of the revolting things that are happening in Ukraine need probably talking about. But equally, I think at these times it's keen to have calm heads and talk about, from an investor perspective, what is happening in the markets. So, Paul, without further ado, I'll pass to you and ask you to give us a synopsis of what's going on.
Thanks, Stephen. Good morning, everyone. Clearly the situation in Ukraine and Russia continues to be unsettling, and it is, as you'd expect, creating a lot of volatility within the markets, within equities and within fixed income. Those regions that have stronger linkages with Russia, Europe, clearly a big importer of Russian energy, and also to the UK, but to a far lesser extent, have seen some weakness. But other regions where there's less linkages, the likes of the US, more self-sufficient from an energy perspective, and also in Asia Pacific, Japan, they've actually done relatively well. We've seen some positive returns this week so far. I think it's really important at times like this to just take a step back and take comfort of having diversified portfolio solutions, and that's not diversification within equities, but also being exposed to fixed income assets, sovereign bonds, which have been able to deliver some positive returns, although themselves have been very volatile, but also alternative assets, something that within the True Potential portfolios that we've been increasing our allocation over recent years. If you think about an asset like gold, that has done particularly well. But the situation is certainly challenging in Ukraine. And the impacts that's having is through commodity prices. We've seen oil really grab the headlines this week. It reached a peak of $116 per barrel. So that's exceptionally high on a relative basis, and that will have a knock-on effect onto the global economy, onto the consumer. But now we've seen oil come back, and we do expect it to come back at some point as some of these pressures that are currently taking place start to ease. But yeah, that's what I said we've seen so far.
Yeah, a really interesting week. As you say, it is always good to take a step back, and we all see the news every day, and it's harrowing, to be honest. Yeah. But what I'd like to sort of get the message across today around is to not panic, everybody. You see a lot of volatility in the markets. However, volatility is two ways at the moment. It's down and up. And my sort of advice is to all the people watching and clients is to keep calm. You're right, using a well-diversified portfolio is absolutely the solution. But remember at this time, everybody, you have outsourced your investments to the professionals to manage in the manner that Paul talks about. And I know people sort of worry at these times and think, the money's better under my bed or in cash. It's not, everybody. I know it seems tough at this stage to talk like this, but it's not a safe haven to put your money into cash. With inflation running at 7+, and interest rates where they are, it's certainly not a safe haven for your money. So please, I hope we reassure you, and certainly all the information that we give out from True Potential is designed to help reassure you that your money is in safe hands, it's being looked after and managed accordingly. On the flip side, which is often quite difficult to talk about, there are opportunities in volatility when we can actually make money through volatile markets. Yeah. So, any examples of those that spring to mind, Paul?
Yeah, absolutely. I suppose the one area where we've been focusing within True Potential and the portfolios that I manage is within alternative assets. So you get different products. Gold would be the classic example, which has been doing very well in when you get unexpected high inflation. But there's other assets called trend following, which looks at market prices or asset prices, whether they're trending upwards or downwards, and can take advantage of them. So even if equities are weak, they can profit. And so that's been a really effective strategy for us year to date, and we've been incrementally adding. We also think that smaller companies are perhaps a little bit more challenged. So domestic stocks are a little bit more challenged given the higher inflation dynamics. So we've been upping into larger companies that are more able to absorb some of these higher inflation pressures, keep those profit margins more higher for longer, and that's been working well for us as well. But there's other strategies as well. Currency comes into play, adding a little bit more to the US dollar, which is treated as a safe haven asset, and that's been appreciating this week as well.
That's interesting, and that leads me to another sort of question for you. Sorry if I'm singling you at the minute, but it's probably wise that I do at this stage. You talk about having the look through this sort of information that we've got. It is important that we make the point to clients and our advisors that we have full look through on all our investments. We know what's happening hour by hour, but equally we can see what's happening in the futures market, which is not available to people who aren't professional investors. So you use things like Bloomberg, and you can look through and see which, as you say, which way the markets are trending. And we're not advising anybody individually to try and time the markets, but you can often see a way of arbitrage within certain asset classes.
Absolutely, and I think that's why clients pay a small fee to active managers, because they have the best tools that are out there. Bloomberg is head and shoulders above anything else in the market. It's extremely expensive, but the information that we can get from it is exceptional, and it really does allow us to manage our portfolios in a much more effective manner, because we get that look through. We know exactly where our exposures is. We know what the market's thinking, and that gives us an advantage. And so, I think that's important.
Brilliant. Well, we'll come back to you, I'm sure, Paul, as the course of the podcast. Push across to Neil. Neil, as I've said earlier, you run the teams that deal with our clients as they call in, as they email in, as they live chat. But you've also got the qualified advisor base that are talking to clients. Mm-hmm. How's that been over the last week? Are you feeling any particular subjects coming through, or do people tend to be taking our advice and keeping quite calm?
Yeah, we've had a rise in calls regarding the Ukraine-Russia situation. Quite, obviously because people are switching on the TV and watching the news, and they're looking at the portfolios and they can see volatility, because as we know, we've got the client side, which they can see a 24-hour valuation. So that we have had a few calls, not too many actually, and they seem to be going down. But realistically, what clients want is they want to have a chat with an advisor. They want to have a chat with a qualified advisor. One, to talk about what's going on in the markets, but more importantly, to talk about what Paul's just talked about, the diversification of the portfolios. And when we're explaining how that works, and how we're invested in a lot of different asset classes and bonds and gilts and stuff like that, the clients are on a better understanding to say that their money is spread throughout. That manages the volatility, if you like, within the portfolios. We've been getting a few calls, but clients are relatively happy once they know how we invest their money.
Brilliant. I think you're right. You make a very important point there, that communication is key. Phil, we talk to our advisors, and what I would recommend everybody, if you have that feeling of insecurity, talk to your advisor. If you're a direct client of ours, talk to Neil and his team. But Phil, you've been talking to our advisors, hopefully briefing them about the information that's coming out from the investment team, and hopefully they can increase their communications with clients.
Yeah, of course. They're all well briefed. They're professional advisors. They do it for a living. if they've been in the industry 20, 30, 40 years, this isn't the first encounter of volatility like this they'll have seen. They've been through countless other market events such as this, so they'll probably offer their clients the same reassurance that we're trying to do today, which is stay in your seat effectively. Obviously, keep yourself informed, but be aware of what your larger goal is for your investment, which is obviously to try and increase your net worth, which is what we're talking about today.
A seamless link, Phil. Thank you for that. A seamless link into the topic of today, which I was going to get to eventually, but now I'm at. So, how to increase your net wealth? Now, it's interesting because I remember when I had a very good friend. When I had one very good friend, I have none now, but I used to have a very good friend. And I remember him telling me, he said, well, you come into this world with nothing. He said, and if you die in debt, you've actually made a profit on life. So I thought, well, that's a really good phrase, and I've always kind of lived by it. But I think when we talk about net wealth, we should talk about levels of debt, but also levels of investment. Neil, I'll push it to you, because it's not prudent to get rid of all your debt. I know people might... Debt kind of feels like a lead weight on your shoulders, but you should probably be advised, perhaps, to live with a little bit of debt.
Well, I think you have to live with a little bit of debt because a lot of people can't live, first of all, mortgage-free, which is probably the biggest debt that you'll have. However, you can be clever about managing the debt. There's a lot of really good remortgaging rates at the moment, on the cards because of the low rates at the moment. And I had a look just online a couple of minutes ago about what sort of fees that you're getting. So you can get as low as about 1.25. I have seen a provider offering 0.99. You might have to fix in for 5 years, but that is a really good way of getting your mortgage payments down. If you've got free net disposable income because you're paying less on your mortgage, what does that mean? Well, then you can put more money into your savings.
Good idea. Yeah, you're right. I mean, mortgage is the kind of benign debt, and it's well covered by your house or whatever. And they always say your house is at risk, but hang on, you are paying it off. But there are more toxic kinds of debt, I suppose. I don't know why I point at you, Phil. I know you've just paid off your student loan, which is probably a very toxic kind of debt, but
highly toxic.
Yeah. We wouldn't recommend people keep the toxic kinds, would we?
No, certainly not. I think that there's more and more of this coming into the day-to-day press in terms of people trying to speculate at huge levels of risk to get rich quick and increase their net worth that way, and that's exactly what we are not about here, and I would never counsel anybody to do that. You hear about cryptocurrency, NFTs, which I'm not quite still sure that I understand what they are and why you would ever have one of them. And also people getting into that vicious cycle of getting into debt to try and accumulate wealth. I've read instances where people get a payday loan and then invest it in something like cryptocurrency, which is highly irregular. I would definitely never recommend doing that. But I think the issue that we've got here is people are looking at markets, people are looking at trying to get rich quick, as it were, and it's very, very difficult to get rich quick, and yet you need to take a longer view about increasing your net worth. Typically, it will take you your whole lifetime. But as long as it is increasing year on year on year, you're on track and you're doing well. I think if you try and double it or triple it in a year, you're going to end up in a sticky situation. That's something that we all need to be aware of, and the whole market and even the regulatory market needs to be aware of, because there's a lot of people who we would deem, from an advice point of view, vulnerable or in a place of vulnerability if they start looking at investing in assets such as crypto, etc. Which is...
I mean, that is very interesting. It leads us actually, ladies and gentlemen, to an article that our CEO of the group, Dan Harrison, has written. It's in the invite to the podcast. You'll see the link, so I would ask you to have a read of it. It's called Let's Get Britain Investing, Not Gambling. And you do allude a bit there to people's sort of gambling tendencies. Suffice to say, we're not in favour of gambling in any manner. When we said NFTs, I sort of looked at you, Paul, but I won't put you on the spot. Generally, if something feels too good to be true, it is too good to be true. Massively increasing your net wealth within a year seems too good to be true to me.
I think so. I think it's fueled a lot by social media as well. There's a lot of people online, saying, I've made this amount, and they're standing behind two really nice sports cars. The sports cars probably aren't theirs, but they're fueling that desire to get rich within a year, 2 years, something like that. And if you have a look at, from a central advice point of view, if you have a look at the clients that we have in there, they, the ones with larger portfolios, the ones with substantial portfolios, haven't made a get-rich-quick scheme. It's been regular investing over, every month coming out as a bill, really. That's what we recommend it should be do. It should be tracked like a bill, your savings, because once it's gone, it's invested. But yeah, I mean, it's, those larger amounts are accumulation over 20, 30 years through regular investing.
Yeah, you point then to people's habits,
Yeah.
which we want to keep them in our investing habits at the minute, savings habits. There's no other habits mentioned today. But you're right, you've got to make a habit of it. Now, you're all, I look around and you're all younger than me to varying degrees. And it is very important that we try and teach people to get good savings habits. It's a particularly pertinent time of year at the minute, and we'll come back to that in a minute. But just generally speaking about regular investing, how if I want to just regularly invest, I'll come about the investment sort of sequencing risk, etc. in a minute. But if I want to make regular investments, how do I go about doing it?
With True Potential, you've got a myriad of ways. You could set up a regular direct debit, as Neil mentioned there. That's something that just comes off, say, every day that you get paid, so it's not even a consideration for your spending. That'll just get put away and invested. Typically, it'll price within 2 days. That's a quick way to get in the market. In addition, if you want to top that up and keep going, obviously we have Impulse Save, which we talk about regularly. The reason we talk about it regularly is it's a great tool. You can Impulse Save from as little as £1. And I think using tools like this to keep squirreling money away. I think the main thing that when I was looking through the notes for this that came to my thoughts were increasing your net worth is a bit of a slog. It's not a physical slog, but you just need to keep going at it. You need to keep putting money away. That is the surest way of increasing it, is to keep the activity up from your end. I'm not talking about putting hundreds or thousands of pounds away each month necessarily. Just keep going. Try and get something put aside for
I
the
think
future.
it's important to. I think people are afraid about talking about it or even thinking about it. My girlfriend is a classic example. I was like, "Do you invest?" No, she's 32, sorry, and I was like, "Well, why don't you invest?" Well, I've got this big student loan. So she did a PhD, and she got her funding pulled. So then she went and got a bank loan to fund it. And I was like, do you know what interest rate you're paying? She was like, about 19%. And so it was that painful for her that she's just blocking it off and just not thinking about it, never mind thinking about investing. So people are afraid to even think about it, I think. So just sat down, let's discuss it. Let's get this off, let's get your debt down. But then just put a couple of quid in your lifetime ISA. Just to get that ball rolling.
Yeah, I think it's the financial education, isn't it? I mean, we've talked about for years how financial education should really start off in school, because we never had those classes in school, about not financial advice, but maybe the basics. And I think that's what's lacking, certainly. But, I think if you are a True Potential client, if you go onto the app, there's a lot of information that you can watch on there. We can watch the morning markets to see how that's performing, but also as well, there's handy tips and guides videos which will show you how to invest, how to do it via the app. So I think it's certainly worth a look at.
Again, really good points there. You're right. It is. People are almost frightened of talking about their financial health. I think people are sometimes frightened of talking about their physical health, and I think financial health is the same. That's why we have the advisor team and Neil and the gang, but also Phil's army of advisors behind to reach out and talk to them. It won't cost you the earth. Don't be frightened. They talk, language that you will all understand. But you're right. And the education point is really crucial. We did a podcast previously on financial education. It is lacking. And the crucial point there, I think, is that when my generation and older were growing up, we had a kind of, not a nanny state, but we had a state where your firm, your company would have looked after you by having a pension scheme. Yeah. They don't exist really anymore. Incidentally, if you have a final salary pension scheme and you need to talk about it, you can talk to us about that and we'll give you advice as to understanding what it is. But those schemes don't exist anymore, so you have to take personal responsibility. So I don't envy you guys being younger, because you have to take this personal responsibility and start investing. And the third final point, which I think was really good, was the app. We need to mention our app and how easy it is to invest on our app using Impulse Save, getting all the good information that we store on it and going forward. So lots of good ideas. Now, on to the crucial point, which is we're now into March. Obviously, April is the end of the tax year. what should, and this is not what could, this is kind of what should people be doing right now to maximise their savings? Who should we start with? Phil.
Okay, thank you. Make use of your allowances is the
Right.
obvious answer. It is an odd time of year, as you mentioned, in our line of work. It's coming up to tax year end. Theoretically, what you should do is make use of your allowances equally throughout the year, or sooner throughout the year. But typically, human nature, people like to leave things right to the end. So there's always a flurry of activity as people just check out what their remaining allowances are for their pensions, ISAs, and fill them up at this point. I think in a perfect world, what I would counsel to any client who's listening or watching would be March isn't necessarily the only month of the year that you need to top up and use your allowances. You've got another 11 months that are perfectly good to do it. We're going to talk about pound cost averaging in a second, no doubt. That's something that you can take advantage of. But going back to Neil's point regarding the apps, Impulse Save, direct debits, it's easy than ever to put your money and allowances to work throughout the rest of the year. I wouldn't necessarily always just leave it until March. Although invariably we will see some.
But also be cognizant that there is a cliff edge for most allowances at the end of the tax year. That if you don't use them, you lose them.
That's correct. Yeah, certainly where the NICE is concerned. I think what's an important part on the app as well, if you go onto the app and you want to put some money in, it will actually tell you what your remaining ISA allowances are left. So you can say, well, I want to put in £2,000 or £1,000 or £500, and it'll tell you what you've got left of that £20,000 allowance.
That's excellent. You're right. Explore your app.
Yeah.
Because there's a lot on there. We've just reinvigorated it with See Next. It's an interesting thing to do.
Yeah.
Pension allowances are interesting. And I'm going to look at you, Neil, to help us with this one. Obviously, you get an allowance every year, but you can use some back allowances if you've not used them.
Yeah, so if you haven't used the full amount of your previous pension allowance over the last 3 years, you can basically put some more money into your pension. So your annual allowance at the moment is £40,000 or 100% of your relevant earnings, whichever is the lowest. If you haven't used that over the previous years, your point before, Steve, as with the ISA, if you don't use it that year, you'll lose it. With pensions, you don't. So you can go back a further 3 years. And then whatever your earnings were the year before that or the year before that, you could put that into your pension and receive, obviously, tax relief on there as well.
Right. So if you've come into a windfall or whatever, you've had a good year with your company, you've earned money, you can actually look back to sweep up some of your lost allowances.
And it's a great way at the end of the tax year to do that.
And that's if you earn £50,000, it would only be £40,000
for that particular year. For that particular year, in which you earned that wage.
Yeah.
Right. Interesting, that we can sweep up and move forward. So use your allowances, everybody. And ISA allowance is really important. Any others that we're forgetting here? They're the major two that we like to talk about. But I think when we talk about getting a regular savings plan going, it is good to get it going so you're funding it throughout the year so it doesn't come like a big, The interesting about tax relief, how it works, I know you get basic tax relief within your contribution, so we would claim that back for the clients.
Yeah, at source,
At source, beg your pardon. So we would effectively gross up your premiums straight away.
Yeah.
So if you invest £100, you would get £120 invested. And then beyond that, if you're a higher or extra higher, whatever the upper rate is, you actually get that back in your tax return. Is that correct?
That's correct. So your annual assessment every year, you would complete that and then you would claim that back.
Good. That's a nice feeling when you get that check back from the tax man. I'm presuming I've done it now. I'm sort of giving away my own tax position on it that I've actually been able in the past to.
I think it's important. It's often forgotten that if you do put into your pension, that you get that additional lift up.
Yeah.
People always think, "Well, I'm not going to retire for many, many, many years like me," but you do get that uplift. So it's almost free money.
Yeah, I think the thing is with starting a pension off very, very young. So if you looked at the pension when you are 21, 22, it almost seems like a boring subject to sort of to look at. People want to go out, they maybe want to go out the weekend, have a good time. But if you realise if you go into Newcastle on a Saturday night and you want £50, where does that get you? It goes within about an hour, 2 hours,
a lot of money,
something like that. So £50 could be going into your pension. And like Phil said before, if that money is taken out at the start of the month when you get paid or whenever you get paid, it's forgotten about. It's a bill, and then you know what you're left with for the end of the month. And it's good financial planning.
If just talking about some of the subjects there, and it's always good to have a little bit of fun on these occasions. But so financial advice is quite boring to talk about.
Yeah.
So when you're out in Newcastle on a Saturday night, do you tell people you're a
everyone,
financial advisor? Or
everyone
not?
falls asleep. So there you go.
You like talking to people about their ISA allowances when you're at the bar, don't you? Neil?
I certainly do. Yeah, we give some good financial advice out the other night.
Yeah, I've
you,
seen that. Yeah.
you live your role.
I do,
It's
yeah,
always
I
good
do,
to hear.
yeah.
But you're right. It is free money. It's 20%. I think it's 20% at source, but then beyond that, you could get up to 45% free money on top of it. Everybody.
And you don't get taxed on anything that it earns within the
That's a
wrapper.
good point. Which is the same as an ISA.
Yes,
Correct.
that's correct.
Do you want to just expand on that point, Phil?
You don't pay any tax on gains that you make in an ISA or a pension wrapper. So, in addition to getting the free money up front from the government, you don't pay any tax to the government when it's in a pension.
Which again is a
Or an
subtle difference to cash. Cash is not an investment, everybody. It's a deposit.
Yeah.
You're getting a very small rate of interest, but you're also paying tax on that as well. So it's a double whammy. Whereas as Phil and Neil have outlined, and Paul, once it's in a pension or an ISA, it's growing tax-free. The taxman will not get his hands on it. And there are tax advantages at the other end of it as well. So it may seem boring and a long way away, but you can have a tax-free cash sum at the end. You can take out income from an ISA. All your income that you take out will be tax-free. So if you're unsure, and we've probably confused you more today, if you're unsure, get in touch. Many methods: email, phone, live chat with your advisor, and we'll happily talk you through and help it. The final point before we move on to funnier things, not that it hasn't been funny already, is to talk a little bit about pound cost averaging. Now, you're probably all very bored, and everyone's thinking around this panel now, oh gosh, he's going to ask me to explain pound cost averaging. Pound cost averaging is the way that how you invest in a fund. Now, does anyone have a bash at investing, explaining it, or shall I have a bash and you can all correct me?
I'll give it a go. And
Good
then
man.
You can go, then you can go.
Yeah,
you
then
can
I'll go.
Pound cost averaging. If I had £100 and I wanted to invest it today, then the risk that you're putting on is that the market could be high and you're investing at a high point, or you could be really lucky and it could be at a low point. By pound cost averaging, you're reducing that risk by getting an average price over time that is typically better than if you just put it in on one single day.
Crucial point. You're right. You're averaging out the high. So you're in a way, with your contributions, monthly contributions, you're averaging out some of the volatility from a purchasing perspective.
Yeah.
Because, ladies and gentlemen, the way to think of it for me is all your investments are in units or shares, but let's call them units for ease of explanation. If the units are priced at £1 and you put £1 and you put £10 in, you would buy 10 units. If they then drop to £5 and you're still investing £10 a month, you would actually buy 20 units that month. And then when the price goes up again, you have a higher number at a higher price.
Yep.
So it works in that manner.
And you're less than the risk when you do it on a monthly basis by regular investing.
Yeah.
Yeah.
So it's a good thing. We can do that when you impulse save, when you take out a direct debit, when you start investing in a regular pension plan with us. Okay, anything else to add on allowances? I don't think we have. It's time to start thinking about them this month to use this year's allowances. Now we move on to the fun bit, okay? Because we always have a little bit of fun in these podcasts. I've got a special guest today that I want to introduce to you all. His name is Joe. Joe is a guest of ours this week. He's been on his work experience from his school with us, so he's been living the life and times of a financial advice firm. So I'm going to introduce Joe. We're not going to put him on the spot and be cruel. I'll put everyone else on the spot first so he gets an indication of the kind of... Welcome, Joe.
Hello,
Nice
Joe.
to see you.
Hi, Joe.
Joe?
Yeah. What are you doing this weekend, Paul? Anything exciting?
Pushing
No?
up a
Good.
fence.
Oh, sorry.
Putting up a fence.
Correct, you're putting up a fence.
Yes, it blew down.
Did it blow down?
Yeah,
Oh,
so
no.
it's all rotten as well. So,
What, you're putting it back up?
well, I'm going to buy a new one,
All right.
and then I'm going to put that up. Hopefully,
You're going to make sure you get the footing. You got to get the footings in correct.
yeah.
Bit of manual
maybe
work.
a bit of cement. Put a bit of
Yeah,
cement. Make sure that it
How
doesn't
deep?
move.
How
Couple
deep
of
are you
feet.
going to... Couple of feet.
I think what Phil's getting at here is he's got some timber to sell him. So,
Yeah, fence building, fence erection. Well done. That's tough.
Exciting.
Yeah, well, don't ask us to help. Anything
nothing
exciting?
exciting for me. However, I have just been accepted for the Great North Run, so I'll be getting the trainers on and pounding the miles.
Crikey, Phil.
I wish I was doing fence erecting or training this weekend. I'm not doing much this weekend. I'm having a quiet weekend. I think I'm going out for a meal on Saturday. Yeah.
I'll come back to you in a minute, Joe, because the reason I asked you three boring individuals, I've got a really exciting weekend coming. Yeah, I'm pleased with myself now. I'm going home tonight, which is always exciting for the people when I get there. And then tomorrow I've got Bradford City playing at home against Swindon, so I get to go to that. In the evening, I'm going out for dinner, but before that I'm going to see Macbeth at the Leeds Playhouse.
Wow.
So that'll be good, because
The Scottish play.
the Scottish, I know I've already,
should mention it.
I'm cursed now. I actually played Macbeth in my younger days, but we're not going to go there today. So I'm seeing Macbeth, and then we're doing the Dales 30, which is 30 peaks within Yorkshire that are 2,000 feet or above. So we're doing them. We're on number 6, and it's this Sunday morning. And you're going to ask me which one it is, and I can't remember. So that's an exciting weekend when you're
It is.
It's much better than mine.
Really good.
Well, I think it seems better than all three of yours, to be honest. Joe, welcome. How's your first week, your only week? How's your week been at True Potential?
Oh, it's been really good. I've really enjoyed it.
Okay. You've been through all the departments, haven't you?
Yeah.
Metaphorically, you've been with marketing, and have you spent some time in wealth management?
Yeah. So spent time with IM, so like seeing what the investments are and like all the spreadsheets and stuff. I've spent time with like basically everyone.
Great. And will you go back to school kind of enthused about working in financial services, or?
Oh yeah, I'm a lot more sure about what I want to do now.
All right, cool.
Compared to how I was when I came in.
Brilliant. And what subjects are you studying at the minute?
So I'm taking history and biology and business as A levels. But I'm taking level 3 with LibF and finance on the side.
Excellent. Well, you'll have made friends here that you can, when you get stuck on your coursework, you can key in and ask questions. And Phil's a history graduate, so you can key into Phil. Yeah.
I'll get him for the central advice team.
Yeah.
Well, why not? Yeah. Well, we wish you luck, and it's nice to see you and have some fun. Okay. Well, I hope you found that helpful, everybody. It is a difficult subject, I think, and certainly talking about increasing net wealth. I think we've hopefully got the point across that you do need to keep some of your low interest rate debt. It's a good thing to keep, but equally then start regular habits of investing and putting money away for the future, which in some instances might seem like a long way away, but in other instances, let me say to you, it comes around really quickly. So, get your habits going, get using your app. Go through your app on the phone and make sure you're using all the advice, all the facilities that it gives to you, and use your tax allowances. It is crucial now that if you haven't used them, you can go on the app and see where you can increase. But if you haven't, reach out to us, your financial advisors, and we'll happily talk you through what you need to do. On that, I will wish you all a happy weekend. It's been nice talking to you, and we'll see you again soon.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.